Imagine waking up in 20 years, checking your account, and realizing your money has quietly grown into a fortress of financial freedom, without you lifting a finger beyond the smart choices you make today. What if I told you index funds could be that silent powerhouse? Let's dive right into what index funds really are, because understanding this foundation changes everything about how you approach your money. Picture a basket holding tiny pieces of hundreds of companies. That's essentially an index fund. It's a type of investment that mirrors a market index, like the S&P 500, which tracks the performance of the top 500 companies in the US. Instead of picking individual stocks and hoping for winners, you're betting on the overall market's growth, which historically rises over time. This setup means you're not relying on a single company's success or failure. If one business stumbles, others in the basket pick up the slack. For someone starting out, say a 28-year-old teacher named Alex who's tired of living paycheck to paycheck, an index fund offers a straightforward entry point. Alex doesn't need to be a Wall Street wizard. He just invests in a fund that automatically adjusts to match the index. But let's get deeper. Index funds are passively managed, meaning no hotshot fund manager is constantly buying and selling stocks, which keeps costs low. Fees can be as little as 0.04% annually, compared to actively managed funds that charge over 1%. Over decades, that difference compounds massively. Think about it. On a $10,000 investment growing at 7% yearly, high fees could eat away $5,000 or more in potential gains after 30 years. Practically, you can see this in action with funds like Vanguard's VTI, which covers the entire US stock market. If Alex puts $200 monthly into it, using a simple calculator online, he'd see projections of over $250,000 in 30 years, assuming average returns. It's not gambling. It's riding the wave of economic progress. Now, shifting seamlessly to why these funds shine for long-term growth, the benefits stack up in ways that feel almost too good to be true, but they're backed by data. First off, diversification is built in. You spread risk across industries, from tech giants to healthcare staples. This shields you from the gut-wrenching drops that come with single stock bet. Remember the 2008 crash? While individual banks tanked, broad index funds recovered and surged ahead. Another huge plus is the compounding magic. Reinvesting dividends means your money earns money on itself, snowballing over time. Studies from Morningstar show index funds outperform most active funds over 10+ years, about 85% of the time. For a 35-year-old marketing pro like Sarah, who's juggling family and career, this hands-off approach frees her from daily market worries, letting her focus on life while her nest egg build. Emotionally, it's empowering. No more FOMO from missing hot stocks. You're in the game steadily. And taxes? Often lower because of minimal trading inside the fund. Sarah could start with a robo-advisor like Betterment, which automates index fund investments based on her goals, turning vague dreams into a clear path. Let's illustrate with a real-world example. Warren Buffett bet $1 million that an S&P 500 index fund would beat hedge funds over a decade, and he won, with the index returning 7.1% annually versus 2.2%. That proves the power for everyday folk. Plus, accessibility. Anyone with a brokerage account can buy in, no massive minimums required. Understanding how index funds actually operate pulls back the curtain on why they're so reliable. At their core, they replicate an index by holding proportional shares of its component. For instance, if Apple makes up 6% of the S&P 500, the fund allocates 6% there. Algorithms handle adjustments, not humans, minimizing errors and cost. This passive strategy taps into market efficiency. The idea that all public info is already priced in, so beating the market consistently is tough. Data from S&P Dow Jones Indices reinforces this. Over 15 years, 92% of large-cap funds underperformed their benchmark. For a young entrepreneur like Mike, who's bootstrapping a business, this means steady growth without distracting stock pick. Practically, let's say Mike invests in an ETF like SPY. He buys shares on the exchange, just like stocks, with liquidity to sell anytime. Dividends flow in quarterly, automatically reinvested if he chooses. Over time, as the index climbs, averaging 10% annually historically, his balance grows exponentially. But it's not set it and forget it entirely. Market dips test patience. During 2020's pandemic drop, index funds fell 30%, but rebounded stronger. Mike, holding firm, would have seen gains by 2023. This resilience comes from broad exposure, turning volatility into opportunity. Choosing the right index fund isn't overwhelming if you focus on a few key factors, flowing naturally from how they work. Start with your goals. Broad market like total stock index for growth or bond heavy for stability. For long-term, equity-focused funds rule. Expense ratios matter hugely, aim under 0.1%. Vanguard and Fidelity lead here. Also, check tracking error, how closely it mirrors the index. A fund like Schwab's SCHB has near zero deviation. For someone like you, perhaps a 30-year-old in sales feeling the pinch of inflation, match risk tolerance. Aggressive for youth, balanced later. Consider tax efficiency. ETFs often edge mutual funds by avoiding capital gains distribution. Use tools like Morningstar's ratings to compare. Example: comparing VLO S&P 500 versus VT World Stock. VLO suits US bias, VT global diversity. In practice, open a brokerage, research via their screener, and buy. If unsure, target date funds automate, adjusting as you age. This choice empowers, turning confusion into confidence. Setting up your investment account bridges knowledge to action, making the process feel achievable. Begin with a brokerage like Charles Schwab or Robinhood. Free to open, no minimums often. Link your bank, verify identity, and you're set in minute. Decide account type. Roth IRA for tax-free growth if under income limits, or taxable for flexibility. For a 25-year-old barista named Jamie dreaming of retirement, a Roth lets contributions grow untaxed. Fund it via direct deposit for automation. Security is key. Enable two-factor authentication. Then, link to index funds directly. Jamie might start with $50 monthly into Fidelity's FZRLX, zero fees. Apps guide you, with tutorials easing nerve. Practically, simulate first. Use paper trading to practice buys. This builds habit without risk, fostering discipline for long-term wins. Determining your investment amount and strategy personalizes this journey, ensuring it fits your life. Assess budget. After essentials, aim 15% of income. For a $50,000 earner, that's $625 monthly. Start small if needed, consistency trumps amount. Strategy-wise, dollar cost averaging shines. Invest fixed sums regularly, buying more shares low, less high. Beats timing the market, which even pros fail at. Data shows it reduces volatility impact. For example, if markets crash, you're fixed by Scoops bargains. A couple in their 40s, saving for kids' college, might allocate 70% stocks via index, 30% bonds, rebalancing yearly. Factor time horizon. Longer allows aggressiveness. Use calculators like Vanguard's to project. $300 monthly at 7% nets $400,000 in 30 years. This clarity motivates, turning abstract goals into tangible plans. Diversification through index funds amplifies protection, weaving a safety net. One fund can hold thousands of stocks globally, mitigating sector slump. Tech bubble burst? Your exposure is limited. Beyond stocks, mix asset classes. Add bond index funds for balance. A 60-40 stock/bond split historically yields solid returns with less drama. For diverse folks like immigrants building wealth, international funds include emerging markets for growth. Example: Vanguard's VT holds 9,000 plus stocks worldwide. If US lags, others compensate. This global view fosters resilience, emotionally reassuring during uncertainty. Practically, review allocation annually. Tools like Personal Capital Track for free. Diversification isn't just smart, it's peace of mind. The long-term growth potential of index funds is where dreams become reality, rooted in historical trends. Since 1926, U.S. stocks averaged 10% annually. Index funds capture that, minus tiny fees. Compounding accelerates. $5,000 yearly at 7% grows to over $1 million in 40 years. For millennials facing pension shortages, this is lifeline. Inflation erodes cash, indexes outpace it. But patience required. Short-term dips happen, yet holding wins. Buffett's advice: buy index funds and do nothing. Data from Credit Suisse's yearbooks confirm global equities' superiority long-term. In action, a nurse investing since 2010 would have tripled money by now, despite crashes. This potential inspires action, promising transformation. Common mistakes to avoid keep you on track, preventing costly detours. First, chasing hot funds. Past performance doesn't predict future. Stick to broad indexes. Don't panic sell during downturns. That's locking losses. In 2022's bear market, sellers missed the rebound. Emotional discipline matters. Set rules up front. Overlooking fees compounds negatively. A 1% fee halves potential wealth over decade. Always compare. Ignoring rebalancing lets allocations drift, increasing risk. Yearly tweaks maintain balance. Finally, not starting early. Time is ally. Even small amounts now beat larger later due to compounding. Monitoring and rebalancing your portfolio ensures sustained growth, like tending a garden. Check quarterly, not daily, to avoid stress. Apps notify changes. Rebalance when assets stray 5% from targets. Sell high, buy low inherently. For a portfolio 70/30th stocks/bonds, if stocks hit 80%, trim back. Tools like Excel or robo-advisors automate. This discipline captures gains, reduces risk. Example: post-2009, rebalancers outperformed static holders by 1 to 2% yearly. It's proactive yet simple. Tax implications wrap this wisely, maximizing keep. In taxable accounts, index funds minimize distributions, deferring taxes. Use tax-advantaged like 401(k)s first. Employer matches are free money. Roth for future tax-free withdrawals. Harvest losses. Sell dipped funds, offset gains. But wash sale rules apply, wait 30 days. For high earners, municipal bond indexes cut taxes. Consult pros if complex, but basics empower most. We've unpacked index funds from basics to strategies, showing how they deliver long-term growth through diversification, low costs, and compounding. The key? Start now, stay consistent, and avoid pitfalls. Action turns knowledge into wealth. Open that account today, invest what you can, and watch your future brighten. Remember, this isn't quick riches. It's building a legacy that lasts. Check out the description or the first pinned comment, because I left some useful links and exclusive recommendations for you. And since you stayed until here, YouTube chose the best video for you to watch now. It's on screen for you.